sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
On radio, on podcast, and online, welcome to the Get Ready for the Future show, helping you discover, protect, and share true financial independence and answering your questions about money, retirement, investing, whatever you'd like to ask us. We are here to help educate and help move you down that road to your financial independence. My name is Scott Inman, along with GenWealth co-founder Janet Walker. And before we dive into the questions, Janet, we always like to, since this is a show about money, and we have Valentine's Day coming up, and we like to have a little fun on this show too. I did a little research, and by research I mean just before we went on the air, I Googled it. So if this is not terribly accurate, my apologies. But how much do you think, for the listeners, you can answer as well, how much do you think in 2024 the average American spent on Valentine's Day? Now, I cannot clarify before you answer that. I cannot clarify if this is all in, like dinner and gifts, or if it's just gifts. So understand that before you guess. But how much do you think the average American spent on Valentine's Day?
I'm going to give people time to think because I've already seen the answer. But meanwhile, I'll talk about the time spent. I will tell you, I am elated to now have an 18-year-old and a 21-year-old, because that means that if they're spending anything on Valentine's Day, it's on them, not me. And also, I'm not spending all the time helping them make that little Valentine's box all through grade school, you know, and buying all the cards and the candy and all of that, and then them coming home with candy that they're never going to eat, and winds up under the bed and all those places. So I'm glad to be at a different stage of Valentine's Day these days.
And I'm thinking, as you tell me that story, that your spending was probably higher back then.
It was.
Even though you can probably spend more on your husband's and you and spending time together, but you probably don't. So here's the answer: $185.51 per person in 2024. That was the estimate per person. A couple other little trivia questions or little trivia tidbits for you as you get into Valentine's Day weekend. We as Americans spend $3 billion annually on roses.
That's billion. A lot of roses.
$3 billion annually on roses. And the state with the most spending, the highest spending on Valentine's Day, is Hawaii. Now, I don't know that they're getting more for their significant other on Valentine's Day, or those roses cost more.
They have a lot more flowers than we do in Arkansas.
That's true too. It should be less expensive because they should be able to just find them. They're all over the place. But yeah, so a few Valentine's Day tidbits there for you as we head into Valentine's Day weekend, and we certainly hope you enjoy the holiday weekend. Now, it is time for us to dive into the questions today. First up, it's Justine from Rogers. I'm 57 and recently inherited $400,000. I have $210,000 left to pay on my mortgage. I want to help pay for my grandkids' college education in the future, and I plan to retire around age 65. What do I do with my inheritance? Well, Justine, I think the most important thing that you can do first is to assess where you are on your track toward true financial independence. You've given us some information here and some things that you want to do. You mentioned the mortgage, looking to pay that off and to support your grandkids' college education expenses. There is a really good likelihood that you could do a lot of these things, but there has to be a priority on determining what you take care of first. And Janet, both you and John have told the story about being on the airplane many times, about securing your mask in the event of an emergency before you help others. And that's really the plan here, is determine where Justine is on her track towards true financial independence first.
So, Justine, securing your mask, as Scott referenced, is really all about making sure that you're going to have the retirement income that you need and want to have in retirement. So a lot of people, I'll take the mortgage as an example. A lot of people might go, okay, well, I got $400,000 and I only owe a little over $200 on my mortgage, so let me just pay it off and that'll be done. But if you do that, then you've lost basically half and potentially more if this is all pre-tax. So you've lost maybe a very significant portion of the power, the future power of this money that you've just received. And so it's important to understand, number one, where you are on your readiness for retirement. And then number two, and this is very key, whether this money is pre or post-tax makes a big difference. And also, frankly, even in how you access it. If this is money that is coming to you in either a Roth or a traditional IRA form, then while the Roth is not taxable, in both of those cases, it has to come out of the IRA within a 10-year time period now that you have inherited it. That doesn't mean that it necessarily has to be spent, but it does have to come out of the IRA. So there are a lot of things that we need to pay attention to in this process, but one of the possibilities, instead of just taking it in lump sum, paying off the mortgage, one of the possibilities is if you're on track and this would not impede your future retirement, then it's quite possible to take a small income stream off of this even before you're retired, and with the goal of still maintaining what you've received, but that allows you to be able to accelerate the payoff of the mortgage so that hopefully that's done by the time that you reach retirement age, and then maybe help with kids' college education as well. And I have to, this is my teacher background here. This was not in a text message. And so it says grandkids, but we don't know if it's grandkid ' or grandkids '. We don't know how many kids we're helping with college education here, so that you may be able to help several of them a little bit, or one of them a pretty good bit.
So let's walk through the step-by-step for Justine. If you plan to retire at 65, I would suggest, first of all, building a retirement income plan that incorporates your guaranteed income sources like Social Security, if you have a pension, with the income stream from your investments. Okay, so if you're 57 now and you're targeting age 65 for your retirement, then we have 8 years for your asset level to grow, and potentially you are adding contributions to that as well. We can make a projection at what your asset level will be upon your retirement age of 65 and how much income that can provide to you on top of your other guaranteed income sources that we talked about. So once we answer those questions through the planning process, you'll be able to determine if some of, none of, or all of the $400,000 inheritance needs to be attributed to your plan. So let's assume that not all of it needs to be, because she's probably got a pretty good idea that she's not going to use all of this money. So we're going to make some assumptions there that maybe just some of will be able to use for your grandkids' college education. Many ways you can do that too. We wanted to go over that for Justine and for the other people listening and watching today, Janet. And the 529 people have heard a lot about, and we get a lot of questions about. So I think we need to talk a little bit about that, and even the recent changes to the law. And by recent, it's still couple of years ago now, but many people haven't heard of this. At least our experience in the client meeting room is that there's still new information. But the 529 plan has been around for a very long time. You can get a lot of money in it, and at least in Arkansas, those contributions are tax deductible on your state income taxes. So there's an opportunity to contribute a lot to a 529 plan for your grandkids and get a tax break now. And then when you withdraw those funds for qualified education expenses for the grandkids while they're in school, and it can even be used for private school in high school and secondary school and things like that. So it has a lot of usage now, and it's tax-free. All that growth is withdrawn tax-free if it is used for qualified education expenses. Now, the one drawback in the past of the 529 is, and we get this question a lot, is what if I overfund it? What if I put too much in and there's some left over?
Well, and frankly, what if not just overfunding by having too much for a kid who does go to college, but what if your kid decides not to go to college? What if we're funding this for a kindergartner and they go a different route after high school? That, like you said, Scott, that's been a big question for many, many years. But now you have the opportunity to convert the $529 to a Roth so it can be used for retirement. And Justine, this gives you a tremendous, game changer opportunity for your grandchildren to be able to make a tremendous difference for them. Because if you think about having a Roth with several $1,000s in your 20s, then that becomes, it gets to a very significant six figures, depending on exactly how much we're starting with, and then, how long we're talking about it growing and the growth rate. It is not an insignificant amount of money that gets added to their retirement with really a very small foundational beginning. There are several rules that come into play on this 529 to Roth conversion. So number one, I would just say that before you do anything like this over time, then be sure that you're checking with somebody who can check all of the boxes on the rules. The account, before it's converted, Scott, has to have been in place for 15 years, but even the dollars that are being converted have to have been in there for 5 years. So I can see a scenario where it's set up, and then if it doesn't get utilized, we just leave it for a while.
Yep.
And then even each year in making those conversions, you're limited in being able to convert whatever the current contribution limit is for a Roth. Like if it's at $7,000, like it is right now for somebody under age 50, then that you can only convert that $7,000 amount in that given year. So you still don't want to significantly overfund it so that you have too much to convert later on down the road. But it's still a very good option.
So 3 key points there to take away for Justine and anybody else thinking about a similar situation here. Assess your own situation. Where are you on your path to true financial independence, and does some of the inherited money need to be added to that pile? Once you've built your plan, then take a look at your options. A 529 plan, maybe you want to just put it in a brokerage account and invest it in a taxable account, which you'll have to pay taxes along the way, but at least that would be there'd be flexibility for a down payment on a house, a car for the grandchild if they don't use it all for education. So determining the type of account there and understanding the rules and having a financial advisor walk through that. And then the third piece that Janet alluded to is the taxes. Understand the taxation on that $400,000 inheritance. Is it tax-free from a life insurance proceeds? Is it an inherited IRA that's going to have ordinary income tax? Or is it in non-retirement accounts? You need to understand that before you start moving that money around. And if you need help, Justine, walking through that process, we'd be glad to help you here at GenWealth. And we also want to invite you to subscribe to our YouTube channel for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. All you have to do is search for GenWealth Financial Advisors on YouTube. I know a lot of people listen to the radio version of the Get Ready for the Future show and had no idea until I just said that we even had a YouTube channel. We've got a YouTube channel. You can watch the Get Ready for the Future show. You can watch the fastest 4 minutes in finance, and you can get all sorts of content right there by subscribing to our YouTube channel. Ready to move on?
Absolutely.
Andrea from Jonesboro is next. I'm 49 and saving for retirement. How should I balance assets between tax-deferred, tax-free, and taxable accounts to get me the best outcome for my retirement income? Great question, Andrea. We get this all the time, not often from 49-year-olds, so kudos to you for thinking about where you should be placing that. I think before we get to the tax piece, we need to talk about the money piece. And it's a little bit different, right? Where do you need to go first to maximize your retirement contributions? And this may seem like a pretty simple answer, but we don't want to overlook it. The natural order of putting money into retirement accounts, regardless of taxation, is to be able to make sure that you're getting your full employer match through an employer plan like a 401k. That may require you to make pre-tax contributions, or it may not. So you can determine through your HR person at work how you need to make those, but you need to make sure you're doing whatever it takes to get all of the free money that's on the table through the employer match. And then once that box is checked, I think, Janet, you have to look at identifying your federal tax bracket now versus where you think your federal tax bracket will be in retirement, and this is where it gets complex.
Well, and it gets even more complex given the current president and what he's talking about with taxes. So let's talk about, absent where we might go with the current president in office, what we want to look at is it probable that your taxes in the future in retirement would be higher or lower than what they are right now. Like if you're a super high income earner currently, then in retirement, it's likely that you would be at a lower tax bracket. But for most people, if your income remains about the same, if tax brackets increase, then you might actually be paying more in retirement than what you are now. So it is, I will say very clearly, a bit of a guessing game about whether we think taxes are going to be higher or lower for any given person. But it's important to consider that, because that plays into, like, do you want to convert any of those dollars now, or how do you want to contribute dollars currently if you're allowed to make that choice based on where your income is?
Yeah, and I think about that tax situation with relation to the national debt problem.
Yes.
Because I know that you talked about the current administration, and they are laser beam focused on eliminating government spending waste. They can eliminate all day long, but if you look at the federal outlays that are required, we are still going to be spending an awful lot of money in the future. And we're not going to be able to dig our way out solely by reducing spending. So taxes are going to go up. And for somebody that's 49 years old, I think you have to go into retirement, or have to look at your future retirement, but with an expectation that you're going to be paying more in taxes at the same income level you are currently at than you are now. So, and at 49, we're going to assume too that you have several years before you're planning to retire. So let's just take an average retirement age of 65. That's still a pretty good ways away. So you have an opportunity to maximize tax-free growth after you make those tax-free contributions. So let's go over the Roth IRA or the Roth 401k, because I think, Janet, this gets confused a lot for folks. They think it's one and the same because it has the Roth name on it, and that makes complete sense. But they are two different accounts entirely. So once you've contributed to your employer plan and you've gotten the max on the match, then you can look to max out your 401k. You will likely, more and more 401k plans have the option of choosing to make that a pre-tax contribution or an after-tax Roth 401k contribution. Any dollar that you put into your 401k counts against a $23,500 maximum contribution. If you put it all in pre-tax, it's $23,500. If you put 10 in pre-tax, you can still put another $13,500 in the Roth 401k. So that is where the Roth 401k can really be an advantage for someone who has that through their work. And since you're turning 50 this year, because you told us you're 49, unless you just turned 49 in January, I guess there's always that chance. If you're turning 50 this year, you get a catch-up contribution of $7,500. So for people who have a work plan, Janet, that has a Roth 401k component, this is a great opportunity to really build up tax-free income.
Yeah, absolutely. And I want to circle back to just kind of helping people understand. You referenced this, the difference between a Roth 401k and a Roth IRA. Inside your 401k, it's kind of funny to me. We don't ever say traditional 401k, but we do say Roth 401k. But all the difference is in the tax treatment. It's whether it's pre-tax or post-tax dollars. And the same is true of a traditional IRA and a Roth IRA, but nobody ever gets the traditional IRA mixed up with a 401k. But that is the same tax treatment. If you're doing pre-tax dollars, then it's going to be taxed later. That's a traditional IRA if you're going the IRA route, or traditional contributions, if you will, pre-tax contributions in the 401k. And then you've got the Roth contributions, so post-tax contributions in the 401k, or a Roth IRA. So all of that to say, you've got your limit, regardless of how you do it, pre or post-tax, Scott, like you said, your limit inside of your 401k at $23,500 plus the $7,500 catch-up if you're 50 or beyond, and then your limit in Roth or traditional, depending on which way you go there, of $7,000 with a $1,000 catch-up if you're turning 50 this year. And there are some income limits that come into play on whether or not you can do the Roth IRA directly. For single filers, that kicks in at $150,000, and for married filers, it's $236,000. So pay attention to where you land on that. If you mess up on it, it can be changed later on, but you do need to pay attention to it. It's just easier to get that right on the front end.
And the last piece to the question was non-retirement money. And I think the only time you really want to prioritize taxable accounts over tax-advantaged accounts in retirement is if you plan to retire before 59 and a half, because most of your retirement plan money, although there are some exceptions in the 401k, but let's take the IRA and the Roth IRA, although there's some exceptions with the Roth IRA too. But generally speaking, your retirement accounts are not going to be accessible until age 59 and a half without a 10% penalty. So you're going to want to avoid dipping into that. So if you're 49 and you're thinking about retiring prior to 59 and a half, there may be, per your planning process, a need to get some money into taxable accounts. Now, outside of retirement, I think a taxable account is a great place to build for pre-retirement financial goals that you might be saving money for. I think having that is certainly great advantage to people along the way. So I don't want to discount taxable accounts completely for sure, but there may be a place for it. But I think in a prioritization, Janet, it's down the list a little bit.
Absolutely. So max out the match first, and then if you're eligible, go to the Roth IRA route. Assuming, well, like in this case, age 49, that definitely makes sense to go the Roth IRA as opposed to traditional. Again, if the income limits are in place, and then go back to the 401k to max that out, and then, like you said, Scott, the last thing on your list would be the non-tax advantaged accounts.
Certainly can be a great benefit when it comes to blending for retirement income from various taxable sources. This is our question of the week. So, Andrea, we're going to send our congratulations by sending you a free Get Ready for the Future show tumbler for being the question of the week. All you have to do is send us an email to show@getreadyforthefuture.com to claim it. And if you've got a question, you can send your question to that email as well, show@getreadyforthefuture.com. Third question today on the show is from Grace in Little Rock. I'm 53. My wife is 60. I have a few million in savings and retirement accounts. Should I give up my $200,000 salary job to spend time with my wife? Will we be okay financially if we both retire now? Well, Grace, a few million needs some clarification. A few can be 3, a few can be 10, right? But certainly it's great either way. And I think it can mean different things to different people. You know, I think it really comes down to the lifestyle that you want to live in retirement. It would seem certainly that if you have a few million, that you'd be set for a comfortable retirement. And I think in most cases you would, but the priority would be here to build a retirement income plan to determine your spending. Now, if you are living on a $200,000 salary now and you have saved most of this few million, I don't know if a lot of it is inherited or how it has been able to be saved and invested, but if this is mostly your own doing, then you've obviously been living below that $200,000 annual income for quite some time. So it should not be terribly difficult to live on $200,000 in retirement income if you have a few million. So you're likely in really good shape to sustain that. But Janet, there is a caution sign here because the investment strategy, even when this looks on paper to be a no-brainer, is critically important in retirement income.
It absolutely is. And Grace, I would say to you that if the numbers work, we are absolutely in favor of having more time with your spouse. That's just, you only get so much, and we don't know how much time you have. We don't know if there are any health considerations already in play potentially, but we know that that's very important, especially with the age gap between the two of you. So we understand that importance, but we also don't want you, in an effort to do something good that feels very good and right for your family, we don't want you to take a misstep financially. So let's talk about some of the things that are very important to consider. Number one, we don't know how much of this few million is in savings versus how much of it is in retirement accounts. And the reason that matters is your accessibility to the retirement accounts is somewhat restricted. It's not that it's inaccessible, but it is restricted behind several piles of rules, we'll just say, that we'll talk through a little bit. But where the savings money is non-qualified, meaning it doesn't have any special tax consideration, which means that it's accessible to you. So if this money is, the majority of it is in retirement accounts, or if what you're going to need access to prior to 59 and a half, that's really the key. If that is in retirement accounts, then we need to make a few other considerations here. Number one, at age 55, if your retirement accounts are in a 401k, you would have access to withdraw the money from the 401k, assuming that your 401k allows for this. The government allows you to have access to the 401k money unrestricted at age 55 per the IRS rules. That does not mean that your plan is built for distribution, so you're going to have to check on that, and an advisor can help you do that. The summary plan description, or the SPD for your 401k, will explain that, and an advisor can walk through that with you. Another possibility to be able to access those qualified retirement dollars before 59 and a half is something called a 72T distribution. This is highly restrictive. So once you go through and calculate, okay, here's the formula, and there are different ways you can do this calculation. Here's the formula that the IRS allows you to use to take this distribution between 53 and age 60. Then once you do that, you're locked in. They do give you one opportunity to recalculate, but that's it. And those payments that you're taking are called substantially equal periodic payments. You have to continue to take substantially equal periodic payments. If you don't, then you're subject to penalties for breaking those rules prior to age 60. So it can be done, but there is a significant degree of planning that comes into play for anybody who is retiring prior to 59 and a half and using what we would call retirement assets to do so.
Yeah, and I think the other piece to that is creating the proper investment strategy as you withdraw those funds, because you can really fall into a false sense of security and thinking you're never going to run out of money because you have accumulated so much wealth. And, you know, under most market conditions, that's probably correct. But there is something called sequence of return risk, that as you sell assets as they're going down in value, in other words, if you have high-risk investments, or if you even just have stock-related investments and you're pulling your income from that, and we have a 2008, or if we even have a 2022, you could be in real trouble, because it is hard to get that share price back when you are depleting your assets quickly from a sequence of return risk. So I urge you to create a plan that includes a strategy from taking from your conservative investments in the here and now and leaving your higher risk or your long-term growth investments for later on in your retirement. And you are going to have to live a pretty long life here, too, if you're at 53 considering this. And I would ask, too, when she says spending time with her spouse, I would ask, too, is there a specific reason that you're wanting to do that? Are there health problems involved with this? Does she have health problems? So what are the costs that could potentially be associated with that, and how would you pay for those in the future? I think that is part of the planning process, too, to determine if your portfolio could withstand a significant increase in healthcare costs.
Including health insurance, really, for both of you as well.
So with the proper planning and the right investment strategy, Grace, it is certainly possible to go ahead and step out from work with a few million in savings at age 53. Our final question on today's show is from Peter via text. What strategies can minimize the tax impact of RMDs? RMD stands for Required Minimum Distribution, and there is a significant penalty for not taking it. If you don't take your RMD, you're penalized 25% of the amount that should have been withdrawn. Now, it is possible to reduce that if the RMD error is corrected, but you don't generally want to make a mistake when it comes to taking RMDs. Now, you don't have to begin taking RMDs at the earlier ages that you used to. It wasn't that long ago, it was 70 and a half that you had to begin taking the RMDs. Now, if you're if you're nowhere near RMD age now, for the rest of us, eventually is going to be up to 75. They have put that on a glide path for the future. So let's talk about that. The government's been lifting that age. You don't have to take them until 73 now. If you're younger, it will be up to 75. And if you have a substantial amount of assets, the RMD can be significant because it is a percentage of your combined IRA, 401k, qualified accounts based on your life expectancy. And generally speaking, this is by no means firm because it's based on a life expectancy table. But in that first year, it's going to be really close to 4% of your overall qualified assets. So if you have a lot of wealth, this does require a strategy. So let's talk about some things, Janet, that we could do to minimize the tax impact of RMDs.
One of the best things that you can consider is what's called a QCD, or Qualified Charitable Distribution. And Scott, it's funny, we really don't hear people, even our peers in the industry, talk about this very much. I think it is a little discussed tool that can be very beneficial to you in terms of your taxes in retirement. So even though RMDs don't have to start at 70.5 anymore, you can start with your qualified charitable distributions at 70.5. And what happens is you're limited on this contribution amount to $108,000, but that's a pretty high limit. So we're in a good situation there for most people. And the money goes directly from your IRA account to whatever charitable organization, and it can be multiple ones that you break down. We see that quite often. But you pick a charitable organization or organizations, and they must be, by definition, a 501c3. So if you go to a really small church and everybody thinks it's a charitable organization, but it's not officially one, you need to know that it is a 501c3 or this does not work. So by doing that, you're going to get a significant positive impact on your taxes, because that money then is not taxable to you. So we get a pretty good adjustment on your taxes. And again, we see people who in retirement, if they are not taking that required minimum distribution before they have to, if they're not taking a distribution from their IRAs, but then they get forced into taking it, they already don't need the money.
Yeah.
So if you don't need the money, then let's take the tax advantages of the QCD, and especially if you're already going to be doing that charitable giving anyway. So I look at it as, if you're already giving to your church, you were going to do that anyway, and you don't need the income, then it's a no-brainer to have that contribution go directly from the IRA to the church and just bypass your checking account in the process.
Another thing you can do, Peter, I don't know how close you are to RMD age now, but I think it's very important in today's tax environment, and I think the change in the inherited IRA rule really accelerated the focus on this, to begin to create and enact a robust, systematic withdrawal strategy in the form of a retirement income plan prior to RMD age. Now, why would I say that? That doesn't sound like you're minimizing taxes, because you're saying pull it out and start paying taxes on it? Yes, because we talked about, if you have a significant amount of qualified assets and you wait until RMD age to begin pulling it out, the amount you have to pull could people that they need to begin to unwind.
Yeah.
This is a great tool to have, the qualified accounts. We love to be able to create wealth with them, but you already you need to be able to begin to unwind them, I think, long before your death, for sure.
Yes.
And long before your RMD age.
You know, even if you don't need it earlier, if you're trying to get smaller portions out sooner so that you're exposing it to smaller amounts of taxes along the way, one of the possibilities that we see a lot of people do is gifting to their kids or their grandkids. So they get to inherit that while you're still here, which means you get the joy of seeing them have those dollars in advance. And again, there's not really a tax advantage to doing that, other than you're getting some of those dollars out before RMDs start. So when you have your RMDs that you have to take, it's not as large of an amount. So that's another possibility for you to consider.
Yeah, and it needs to be said, even if it sounds pretty simple, you don't have to spend the money that you take out, right? You can gift it, that's one thing, but you can also put it turn it around and reinvest it into a taxable account. And that has its advantages as well, especially when it comes to transferring to the next generation. We are out of time. Great questions this week. Really enjoyed everyone getting them to us. It is time for our final thoughts on the show, and Janet, we'll start with you.
I feel like this show was deep in a need for planning.
Yeah.
When we look at least 3 out of the 4 of these questions, you inherit $400,000. That is a significant change to your financial situation. When you're looking at, do I retire early, especially years before age 59 and a half? And then what in the world to do with required minimum distributions? In all of these cases, again, there's a significant need for some deep planning. Don't just come to those decisions and go, well, here's what I want to do, and roll forward. Be sure that you know what the consequences, pros and cons, are in either direction, and get a plan on paper on purpose.
Yeah, and I think just to piggyback off of that, everybody thinks you have to have the the right investments, that's the key to true financial independence. Well, certainly the right investments matter. The right investment strategy matters. But I think these questions highlight the right decisions matter even more than that. Where you deploy your dollars, how you choose to invest them, and what type of accounts, how you deal with taxes. Those are all things that you don't want to make a mistake on, and it can definitely be to your advantage to hire a financial advisor, one who does financial planning first and investment strategies that flow into the implementation of that plan. It can be to your advantage on your path to true financial independence. And if you'd like to reach out to a GenWealth team member, we are here to help. That is all the time we have for this week's Get Ready for the Future show. Thanks to all of our questions this week. Get them into us, show@getreadyforthefuture.com, and we'll hear your question on the air next week. Happy Valentine's Day, and we'll see you next time.
The GenWealth financial team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.